Welcome to the Property Investing Roadmap Podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions but then make a very quick decision, and they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build and optimise your property portfolio.
No one's going to invest to make a loss. They're going to make profit.
Well, welcome back to the podcast today. We're talking about why investing matters. Why is it so important that you invest, and how you can future-proof your lifestyle. Now, we'll talk through some examples as well that I do cover in the book about people who invest, who don't invest, and I want to get to really why it's so important that you make those decisions earlier in life to start investing, because it can really set you up financially for the future and gives you choices. And that's the really critical thing I want you to get out of today, is the choices that you have when you start to make your own investment decisions and not just rely on the government pension. And super's great, but you don't want to be that your only source of investment when you get to retirement or when you want to make choices in life. And very lucky today to have us a special guest, and today it's Fran Hughes, a senior wealth advisor. Fran's going to be sharing her expertise and personal insights on investment strategies. Has been a financial planner, I believe, for over 35 years. You must have started when you were 7 years old, Fran. But tell me the story about your background in financial planning and why you got into that space.
Thanks, Damien. Thanks for having me. Look, it's an interesting story from a point of view of, we are the same vintage, Damien. So we go back to the 1980s. Oh my goodness, when I first started, the first month I started was actually 1987 November, and if anyone remembers, it was Black Monday. The share market was tumbling, and there was kind of carnage on the streets and St George's Terrace. But what I learned from that was very much so, it's about, here it is, protect your wealth, but continue to invest, because here as we sit today, the market's just hitting, and the share market that I'm talking about, and also property market, is that it's hitting new highs. So keep going, and there's just so much to it. But now, since then, of course, I've gone on to become a financial planner. When superannuation guarantee was introduced in 1992, I got to cut my teeth in that space, and I've gone on to build 2 award-winning financial planning firms.
Well done. And look, I do remember the crash of 87, albeit I wasn't in the workforce then. I was still studying, but it was, I remember it was front page of the paper. And but if you look back, how many times, it's not just the stock market, property market, any investment market, if it's got good, solid long-term fundamentals and you're in it for long enough, you're generally going to make some pretty good money, aren't you?
Yeah, absolutely. I think about in 1992, superannuation guarantee was introduced, but here it is in 1994. I bought my first lot of shares, and that was CBA, Commonwealth Bank, first floated $5.40 per share. I only bought 5,400, by the way.
Have you still got them? Because
I've still got them.
They're a lot better than $5.40 now, I can tell you.
I think it hit something as high as $140 per share. So I'm sitting quite nicely. In fact, the dividends now pay more than the initial investment.
Yeah, well done. And look, one of the things that do you find? I mean, everyone's got super now. I think the mentality though for a lot of people is, well, that's all I'll need because I'll get a pension and I've got some super and I'll be comfortable. And look, certainly having super, yeah, when I was in the workforce, it was always there, but it was only, I think, 3 or 4%. Now it's obviously getting closer to 12%. But for a lot of people in that Gen X bracket, their superannuation may not be that fabulous because it started off a lot lower, didn't it? And what is I think people don't realise, the pension, how much is an age pension? And here we are in the 2020s, and it will obviously change over the years as they index it. But what does life look like for a couple on a pension? I would have thought it would look pretty grim.
Yeah, if I think about the last 35 years in this particular profession, and the last 5 years where I'm advising clients around how they should retire, a typical income that they would need, so someone who's age 67, kind of relying on the age pension as well, the total about 80,000 to have a nice modest retirement. Of that, you'd probably have about 35,000 coming from the age pension, and you really need to supplement then the rest that comes from superannuation and so forth. But coming back to it, I look at it from another point of view. As we move into this space, I'm looking at, the old traditional work, and then retired at age 67 and then lived a comfortable lifestyle. That's kind of changing and evolving. Now we're looking at the modern retirement. What is the modern retirement? What it suggests is that you've saved up along the way, you've invested along the way, and now you can actually take mini retirements whilst you have your health and time. So you coming back to your question, can someone live on the age pension? Yes. If I think about my mum and dad who lived on the age pension, for sure. Did they go on those fancy holidays? No, they did not. Did they kind of live on baked beans and toast? No, they didn't. But it was very much a modest lifestyle, earning $35,000 in an old age pension. Mm-hmm.
Yeah, and look, I guess it depends what your aspirations are, doesn't it? But for most people, I don't think they would envisage that's their life, that they want to be living on that sort of level of income where you've worked hard all that time. You want to be able to take those trips and those journeys. And I guess that's what we're going to cover today, about why it's important to invest, because you get those choices. One of the things one of the reasons I started investing is I was looking at other people who were successful, and I was looking at then also at if you're reliant on the government and pension, that's subject to change. It's already gone to 67. Mm-hmm. Now, there's all these pressures on it. Now, will it happen in the next 5 years? Probably not. So someone in their 50s now is probably safe from getting that put up. But I would imagine certainly people in their 30s and maybe even younger, that by the time they get to the pension, it might be 70, could be even more. Now, obviously, we don't know that, but even super. I think the age to get it now is 60. I do always wonder, well, will they change that? Will they make that higher and mean you have to be 65 to retire? Look, we don't know, of course, Fran, but just tell me how you talk to your clients, the importance of investing, not just relying on super and the pension. What do you say to those clients about why they should invest?
That's a great question. I want to come back to your point around the actual age that continues to change. One thing I do know, having been in this profession for these many years, is that change is constant. If I think back to mum and dad, they could retire at age 55, gain their age pension as well as gain their super. For Gen Y, it's probably age 70. So coming back to your point, why should they invest? The investment, it provides income, or it provides a solution to be financially independent, the now, the then, and the future. I always think about super as kind of the future. For Gen Ys, if you're a 30 or 40-year-old, you're thinking about, well, actually, 70 is a long way away. That's 40 years away, right? Damien, I mean, for you and I, we're a lot closer to that. But
still a long way away. In my head, at least, maybe not on the birth certificate, it's a long way away.
But for me now, at age 55, and we serial entrepreneurs. So for me, at age 55, I can sit here and say I'm on a mini retirement. And why is that? Because it goes back to the importance of investing. And what investing does is kind of says, okay, your super, let's kind of park that. That's for the future. But what do I want to live the life that I want to live right now? So I'm going to need funding, but I'm also going to need passive income. And that's what investment does. So having a portfolio of property allows me to be able to just live on that rental income and also be financially independent and have a mini retirement and do the travels that I want. By the way, a mini retirement does not mean skinny. That is, you don't have to have kind of, live on baked beans and toast. One of my clients kind of said, oh, Fran, do I have to live on sauerkraut? No, darling, you don't. You're going to go on that cruise. You're going to go on that amazing holiday. And by the way, let's kind of tick off your life list.
I guess the important thing from that, Fran, is though that you, somewhere on that journey, made decision to buy investment property, buy CBA shares, which was a wise one as well. And that's given you those choices, hasn't it? Because if you just had your money stuck at your age and stuck in super, you couldn't get access to that, could you?
Yeah, spot on. So what that looks like is diversification is key. I'm not advocating necessarily that this is advice for everyone, but you've got to come back to what is affordable. So if I look back, and history it tells us so much, right? So if I look back to the average house price in Perth in 1992. I think it was, Damian, would have been, 60, 70,000?
Yeah, it would have been around that sort of range, yeah.
And today it's just sitting under 700,000.
Mm.
So if you invested in just one investment property, you would have paid off that loan by now. And in fact, that property would now generate a rental income for you. Now imagine if you actually took a little bit more of a further step and bought 2 investment properties, you'd have a portfolio of 1.2 million, thereabouts. Now I referred to the 4% rule on income, and it's the same with rental income, I suspect, is that if you're 1.2 million of investment properties generating a 4% rental yield, that's going to give you a passive income to fund your retirement, mini retirement,
Yeah.
as we're a lot younger. But, for someone who's also in their 40s, it allows them to then not worry about it financially, go on and have young families, go on and have on a travel, take 2-3 months off. Because what we're also seeing at the moment is that if you don't have that, potentially you'll continue to work and there'll be a sense of burnout. Everyone's needing a little bit of a reflect, reframe and just paused for growth.
Look, ideally, you would have enough investments to live off the income stream. And I guess the great thing about that, if you get to that, would be that your income should be rising at least at the inflation, if not more, based whether it's property or whether it's shares, based on the economy. And that's the ideal world, right? But not everyone's going to be in that situation. But there are ways you can sell down some of your assets and over time, so to supplement you supplement the income if you need to. And ideally, we wouldn't have to do that. We just have these assets and we keep them forever. And you might, if you want to, leave it to your kids. But at least that is that if you don't, even if you don't get to that level. And my philosophy is, you invest and as much as you can, and then you can make the choices later. Like, because we sit here today and. Who knows where the property market and share market are going to be in 20 years.
Yes.
I'm pretty confident they'll be up, but we don't know exactly how much and how things are going to go. But if you invest, you've got at least choices, don't you?
Yeah, and the one thing I do also say is make time and discipline your friend. And so what time and discipline does, it allows you to be able to just let those assets do what they're supposed to do.
Yeah.
Whether it's shares, whether it is property, over time, it would appreciate. Yes, there will be times that it will go down, but if you give that time and the discipline to be able to hold on to those assets for the long term, that will pay a lot of dividends in the long term. Yeah.
So what do you say to people? There'll be people listening to this podcast in their 20s, 30s, even in their 40s, early 40s, and they go, we've got 3 kids, I've got a mortgage, I've got money going super, I don't need to invest, I'm okay. What would you say to someone like that?
I would say start thinking about your future self. And I love that because, if your best friend, right, was your future self, what would you say to your best friend? Would you be able to pay it forward? Would you be able to think about, okay, what I'm doing today is going to have a reflection of what my future self's going to thank me for? And so I talk about the 80-20 rule. Now, the 80-20 rule kind of says for someone who's just starting off with a job, you probably don't have the overheads as someone who might be in their 30s or 40s. So, in fact, you could put away 20% of your income. You're not going to miss it necessarily. Now, here's the thing about the 20%. You can either save it or invest it. And imagine if you spoke to yourself in 10 years' time by doing exactly just that one thing. You'd not only have enough of an emergency fund if you didn't invest it, but if you invested it over 10 years, and I mean, you and I know, the 7-year cycle. So if you invested it over 10 years, one would hope that that asset will appreciate over time. Now you've got an asset that's going to pay you an income. It's like you're becoming your own boss. And that's the power of investing.
What would you say? So ideally, the best time to start is yesterday, right? That's always the way. Is it ever too late for someone? Do you ever get people to come to you and say, "Oh, I'm at this age bracket. Oh, it's all too late for me. What can I do?" To me, it's never too late.
It's never too late, but it always comes down to their risk appetite. I think if you've got a longer period of time, then you've got the ability to make a few mistakes. So if I think back to the last 15 years of property, it's kind of been relatively flat as inflation's been low and interest rates have been low. It has kind of seen the growth as what we've seen over the last 3 years. So if if you've got that 15-year time frame, you've got the ability to just hang out and just make sure you hold on to those assets. However, if you're talking about whether someone who's in their 50s or closer to retirement, should they look at property, it all comes back to what is their risk appetite. So I'll give you an example of, and I know you've got a couple of case studies in your book, which is amazing, by the way. But if I think about someone who's in their early 50s, and they're not thinking about retirement or at least, stopping work for another 15 years, they could consider something like an investment property. And at that point in time, we would probably see two 7-year cycles. What they would have now is what we refer to as a boost to their super, their nest egg. They might not necessarily want to hang on to that investment property, but they could sell it and then put it into super and live on it. So that's really a really cool strategy as well. Yeah,
and look, it's a very complex world. The whole interaction of superannuation, pension, and all this other things you can do. You can apparently top up and put in 120 grand a year. I was told the other day, which is beyond my skill set. But that's why we have good financial advisors out there who can help people with that. But and what would you when you people get to that point? So let's say someone. In an ideal world, they're going to live on that income, right? But there will be times, as you said, that they might have. They want to live particularly when you get to that early phase of your retirement, when you're hopefully still very healthy, your 60s, maybe even 70s. Life's good. This is when you want to spend, right? You want to go on the cruises, you want to travel the world, and some people have this thing. Well, I don't want to sell my assets, but sometimes that's okay, isn't it?
It's okay, because if we think about stock on a shelf, so if you go to any retail shop, you would say they do turn over their stock. It's the same with property, right? So what used to be a really great location maybe 15 years ago might not necessarily be the ideal location, but you consider that as far as tax structure and the intent of what you want to have done with the capital. So the making sure that it's kind of, changed over is always a great strategy. What I would recommend and suggest to anyone is seek professional advice, whether it is from Momentum Wealth or from your financial advisor. You'll be able to get kind of those three aspects. What is the tax implication? What is the long-term growth of that asset? What is it going to cost you? And how are you going to definitely use it for the future?
And what age do you find most people reach out to a financial advisor? Do you get many in their 20s, or is it mainly when they get to that middle age, 40, 50 bracket, they start saying, oh, better go and get some advice?
Great question. As humans, we always kind of go, okay, I can see the red lights, and I go, oh dear, I can see kind of that edge of retirement. I better go and seek financial advice. My encouragement to any of your listeners is you can seek financial advice at any time, because in your 20s, you're going through a whole different gamut of financial struggles. When you're in your 30s, you're maybe starting a family, buying your first home. When you're 40s, you've got the whole family, the school fees, all the actual overheads, that will be coming your way. And in your 50s, you kind of relax and go, now I can think about retirement, and that's when I'm going to get professional advice. But imagine if you started a lot early, you'll be so much more further ahead if you did.
Absolutely. So, Fran, if you now look a lot younger than the age you mentioned, but tell me, what would your advice be to Fran at age 21 that you'd do differently to what you actually did? Anything stand out? You go, I wish I'd done it that way.
Damien, and this is between you and me. I'd probably would have
and
bought.
Some listeners, but yeah.
I probably want to buy more properties, knowing exactly what the outcome is and how I can use that to my advantage now that I'm in my 50s and definitely in my 40s.
Yeah, look, my advice to myself would be, why did you keep selling them? I used to trade them. Now, I didn't have a job, so I couldn't eat bricks, so I had to get income from somewhere. But I look at all those properties, and I sometimes go back on RP data and look at the values today, and it's got when I sold them, and I sometimes feel like kicking myself. But you know what? I've gone okay in life, Fran. So I won't beat myself up too much. So, Fran, look, thank you very much for joining us today. Greatly appreciated. And any final advice you'd give to somebody thinking about investing, unsure what to do, what would be the best piece of advice you could give?
Knowledge is key. Go and seek the knowledge from the professionals. Go and see also someone who's done it before. and kind of, if you want to follow their steps, follow their mentorship, do that, but don't do nothing. Make sure you do at least something and seek financial advice.
And I think that's critical. No matter what you're investing in, whether it's shares, property, whatever, and it can be very overwhelming. There's so much information out there, US shares, Australian shares, all the ETFs, there's so much information, and most of us are running our lives trying to work in a job or running a business, and we don't have time to sit down and read the AFR, even though it's a good read, from cover to cover every day to get all that knowledge. I think that's just a critical thing that I would suggest to anybody is whether it's property, whether it's investment advice generally. There's lots of good professionals out there. There's in the financial advisor world, in the real estate advisory world, buyers agents and others. And the important thing I really want people to get out of today is it's never too late to start. Yep, we all wish we'd started earlier, and even if we did start earlier, we all regret those mistakes. So you can't change the past; you can only change the future. I really encourage anybody who's listening. It's never too late to start investing. The sooner you do it, the better. Picking the right assets is going to get you to that your ultimate goals. Gives you those choices, like Fran's on a mini retirement. I'll do that one day maybe. But my dad's 80 still working, so if he's listening to this podcast, he'll probably still be working because he'll never retire. But I won't be that person. I will eventually one day. But it's about life choices, and I think that's the critical thing. When you control your own financial destiny, you get to make the choices in life, not rely on the government and their policy. I think that's critical. So thanks again, Fran, for coming. Fantastic to have you. Really appreciate it.
Thanks for having me.
Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest.